Good afternoon, because it is actually now afternoon. So I was handed the challenge of moderating this panel, and I didn't like the title, Financing Trends in a Challenging Environment. It kind of says everything and nothing. So I went with How to Invest When the World is Distressed. Now, I write a little bit about Europe, which has been fairly stressed and de-stressed. And then central banks, Paul was talking about this earlier, have dumped the equivalent of 20% of GDP into the global money supply. And yet, despite distorting every stock, bond, and house price on the planet, parts of Europe are still in recession, if not in deflation. The notion that we're going back to, or we have achieved a new normal, I think is calling it too early. Again, as Paul Tucker said on the prior panel, it may take 20 years to get to the new equilibrium set of institutions in terms of where the global banking setup is going to rest. Now, 7 years out from the crisis, the global investment environment seems quite different from what anyone would have anticipated. There has been no return to the status quo ante. Rather, regulators, politicians, and publics have identified the financial sector as the source of the crisis and have sought to rein in risk. Whilst understandable, this is somewhat pointless in the sense that it cuts against the point of the financial sector, which is, of course, to concentrate risk. So if you're trying to de-risk the thing which you use to concentrate risk, that might be somewhat at cross purposes. Similarly, the funding environment investors face is distorted by these very same policies, which are designed in many ways to save their assets. In some, the investment map is now changed, but we don't know how. Luckily, we have 4 people who can help us build a new map. I would actually ask them to come to join me up here now. First of all, the Finance Minister of Luxembourg, Monsieur Pierre Gramegna. Mr. Huang from the Bank of China. Have a present here. Mr. Kyttack from the Korean Development Bank. And Monsieur Didier Valet from Societe, Generale. Minister, if I can begin with you. Why would anyone want to invest in Europe just now? It seems to be not just distressed, not even at rest. It seems to be confused about who it wants to be. What's going on from your point of view, from the point of view of a financially dependent, but nonetheless quite well-off part of Europe?
Oh, well, maybe we should change the moderator.
Many have tried.
Well, I promised Alex Thursby that I was going to start with the joke, but it was not this one. And in fact, I find the title of this wonderful 7th edition of the conference a great success, and I would like to congratulate the sponsors. But I have a problem with the title of the conference, which is Global Financial Markets Forum. And as I told Alex, forum comes from a Roman word, which means market. So it means global financial market. So global financial market square. So why not? Well, Luxembourg and Europe, we are a crossroad. That's where we are. And I've been a little bit afraid when I read that there's an West-East strategy, but obviously there should also be a strategy that goes to Europe. And in this country here, I think it's very easy to see the common points about the UAE and the European Union and the European Union single market. So seeing it from the standpoint of Luxembourg, which is an international financial center as the UAE is, I think we have probably a more optimistic view on what can be done to attract investment in European Union. As we have very little time, I'm going to use a kind of telegraphic style, and I'll give you 4 reasons why I'm really optimistic about Europe in the year 2015 and beyond, because I think that we're going to outperform the outlook of growth that has been said. Growth is going to be between 1 and 1.5%, all the statistics say, and we're going to do better. Why is that? Because we are rebuilding confidence on one hand and predictability, which means looking at also medium and long term. And what are the 4 reasons? First, European Union has done its homework. It has got out of the euro crisis. We had a kind of teenager crisis 3 years ago, and we've done our homework in the sense that we have completed the banking union, of which many people say that we could not do it. So now we have a common umbrella, we have the Single Resolution Fund, and a common supervision of banks. So our banks have been all assessed, all the important banks. We know how healthy they are, and we know out of 130, most of them came away with very good rates. Second point why I'm optimistic, yes, Europe has stagnated in the last 6-7 years, and one reason is due to the fact that investment didn't pick up, especially private investment. Now, the new commission, led by the former Prime Minister of Luxembourg, Juncker, has announced the Juncker plan, which will encompass 315 billion investment in the next couple of years, which is going to leverage private investment. So that's the second reason why I'm optimistic, and I can tell you that as a future chair of the European Union, Luxembourg will push this item quite a lot, as I will be presiding to the destinies of the ECOFIN from July to December. This is going to be an absolute priority on my agenda. The third reason why I'm very optimistic is something to which the UAE is contributing a lot, and that is falling oil prices, which is going to boost consumption. So you will see consumption pick up in Europe quite a lot. And the fourth reason why I'm happy and pleased to say that I'm optimistic about European Union is the quantitative easing of the European Central Bank, which starts today. So I've come here on the right day. And this money that's going to be sent into the market by the European Central Bank is going to trickle down to the consumer and to the investors, which is different from the policy that was done up to now, where the generous policy of Mario Draghi, where he said we will do whatever it takes to support the euro, was meant to secure the financial crisis, but it was not meant to trickle down. So we have a big difference here. So these are the 4 reasons why I'm confident, and you will see that growth will be much better than forecast. Now, what does it mean? We need to rebuild, I said, confidence. I think all the measures I mentioned here will rebuild confidence, and we need to think about predictability and long term. Now, of the two of the things I mentioned are long term. One is the banking union, and the other one, which is long term, is the investment strategy. Now, the other one, quantitative easing and falling oil prices, is maybe more short term. But I think we are at a stage where long term and short term indicators are converging in the same direction. So I think we have a very good constellation now for growth in Europe. And if I look at it from Luxembourg as an international financial center, we're going to be an actor in this in a way with our very important investment fund industry. We're going to be one of the players to boost investments all over Europe on the one hand. On the other hand, we've also been very active in Islamic finance, and I think Islamic finance will be very interesting in the years to come. We have launched a sovereign sukuk denominated in euro last year. It was the first one ever, and I think that we have a lot to learn from Islamic finance, because Islamic finance is based on collateral. You need to have collateral, so that gives confidence, and if you have more confidence in the lender because there is a collateral, well, you will boost the energy of those who want to use this type of finance. So I'm very pleased to be able to say that here. We have learned from the crisis that you should sell and buy products that you can explain to your grandfather and to daughter. And I think Islamic finance for many of us was a little bit elusive a couple of years ago. I'm very confident for the future. And for my part, I can say that in Luxembourg, we're going to produce more sukuk products in the future, which will help attract additional investment to both our regions.
Excellent. So we have a bullish outlook on Europe. I haven't heard one of those for a long time.
Yes.
And that's good, actually. I'm quite pleased. I don't know about you. I think that's great. The place that everyone has been bullish on for the past 20 years is, of course, China. And now there are some bearish voices. And one of the chief concerns is that, and speaking of the long term, there's a stated aim, which has been discussed here already at the forum, of turning China from an export-led growth nation into a consumptive nation. Two issues immediately present themselves. One is the internationalization of the currency. But the second one is the role of the financial sector in that transformation. So could you speak to those issues for us?
And also, I'm delighted to be here. And also, I have a complaint to make as well. You know, before I enter this stage, you know, and our professor told me you only have 5 minutes, you know. I asked for 1 more minute more because, you know, my English poor. On top of that, I might be the only one from China to talk about China economy. And also, before I answer your interesting questions, I need to very briefly examine the business model, the development model of China. China adopted its open door policy in late 70s. And the China business always being export-oriented and investment-driven economy. And this strategy contributes to a very fast and strong development of China economy, at the same time, the rise of middle class. Mm-hmm. So, but on the other hand, because there is an insufficient financial market, lead to a resource misallocation, some misallocation, and overcapacity in some sectors, and lead to funding difficulty for small and medium-sized companies. As the labor costs keep rising in China, and environment conditions worsening, you know, so this model do not seem be sustainable in the long term. On the other hand, because of many years economic fast development, China China consumer has a very strong purchasing power. And I tell one figure that just during the last Chinese New Year, there were 450,000 Chinese visited Japan. You know how much money they spent during this holiday period? They spent $1 billion. So this is the strong middle class, you know, their purchasing power lay a very solid foundation for China economy to shift from investment-led, export-oriented to consumption-driven economy. This is, I think, you know, on the one hand, there is an adjustment. On the other hand, really, there's very strong purchasing power. And regarding the economic transformation, I think is more to do with internal financial reform rather than international stability. Because if you look at the China banking system, right now, the interest rate is not fully liberalized. So the bank tend to lend money to big and well-established company rather than small and new one. On the other hand, the bank loan right now contribute to 70% of the total China social funding. And this got to be changed. So there need to be a new product coming in, like develop IPO, debt issuance, you know, the venture capital, the private equity. All this will be further developed and encouraged. And also on top of that, why many people go abroad to purchase many goods, you know, because Chinese manufacture now still focus on low-end product, and which cannot meet the requirement of the middle class, you know, requirement. That's why you see many Chinese went to overseas, purchase a lot of goods. I believe a lot of people also come to here to buy goods, good quality goods. So all this is to do with domestic financial reform. Of course, international stability is also important. Will also provide a constructive environment for China shifting to a new model. But it's only a good wish. It's hard to achieve. It's also beyond one single country control. Even if you look at America, you still cannot say today their financial system is stable. Because they also experience many crises. So international stable is good to have, but not something can rely on. So China new shifting, the new transformation, more rely on domestic financial reform. But financial reform alone is not enough. That's why China now is introduced recently. Probably you know that the government already announced that it's a new strategy. New strategy they call the One Belt, One Road. I don't know whether you heard or not. This is a big strategy. I think this morning somebody said that China have always very good long-term planning. This is really long-term planning. This is to leverage China's current capacity to other countries in the One Belt, One Road area to help to build good quality railroads, ports, etc. And I hope this will be a win-win situation for China and the country involved. Thank you.
Thank you. It's that figure of 1 billion of expenditure in Japan is incredible because it suggests two things. First of all, someone is spending money in Japan, which is a good thing. But perhaps more importantly, we tend to think now, we still think of countries as being consuming units. But what you're suggesting, there's more of a regional dynamic to consumption, to production, to investment. So thinking narrowly about countries may not be the best way. But nonetheless, that's exactly what I'm going to do next. Now, turning to Korea, before we had the miracle of Chinese growth, double-digit growth for 15 years, Korea did exactly the same thing back in the 60s and the 70s. Korea was the original miracle economy. Now you find yourself, by my reading at least, in an interesting place because you have China moving up the product ladder, and then you have the very high-end producers such as Germany and the United States, and you're squeezed in the middle. I've heard this called the nutcracker effect. Do you feel as if your nuts are being cracked?
Personally, I don't feel like I am not cracked. But first of all, I would like to thank the MBAD to invite me to such a great forum. I would say such a great market. Yeah. And after the 2008 financial global crisis, we are experiencing slowdown in our economic growth rate as well as decline in our export. The most important lesson the global financial crisis taught us is that we have to prepare for the volatile, whimsical movement of foreign capitals. Right after the financial crisis, global financial crisis, the Korean currency lost its value by 60% in 6 months. Then later it gained its original value. So the Korean government is now introducing some macro-prudential measures, such as the levy, bank levy on the short-term bank borrowings, etc. And the question of you mentioned not a correct question. So we do have a sense of crisis. So we are sandwiched actually, and we have been overcome such a crisis many times. The two oil crises in the 1970s and also 1980s. So we have Asian financial crisis and the global financial crisis as well. So we have a very highly skilled and educated population. In fact, the tertiary education rate, the enrollment in the tertiary schools is the highest in the world. And our research and development expenditure is compared the vis-a-vis GDP is second highest in the world. Mm-hmm. And also we have utilized the labor force. That's female labor force. Our female labor participation ratio is around 53%. I think that's about 8 or 9% points below that of OECD average. So we are one of the most rapidly aging society. So we need to augment our labor force. The female labor force can, make it up. And the current the government introduced so-called creative economy as a new engine for the growth of Korean economy. By saying creative economy, we mean that the many startups and SMEs with great ideas and also the technology can commercialize and to produce new goods and services and creating new jobs and also new industries. That's we are hoping for that. For that, the Korea Development Bank is doing our part for providing the financial resources. And I'll talk about that in the second round of the question. Thank you very much.
Right. So Europe's going to do better than we think. China has a plan. They've executed them before, and they're quite good at this. Korea has seen many crises before and come through them on the other side. This all sounds very good. Now, let's turn to international banking. Your business model is being re-engineered one regulation at a time everywhere. Your yields are being squeezed and distorted. Your bonuses are being escrowed. Your compliance costs are going up. And yet, there seems to be tremendous opportunity, as there always is coming out of crisis. How does an institution such as SocGen capitalize upon this uncertainty, which is also opportunity?
Well, first, I would like to thank also, let's say, the NBAD organization for this Global Financial Market Forum. To answer your question, I think that it's a big challenge that banks are facing today, because even if there is relatively good news on the macro side, and we should not forget that, for example, in 2014, there was a lot of elections with positive outcome when we look, for example, at Modi in India, Jokowi in Indonesia, changing a little bit the landscape. There was, let's say, revision upwards of growth, at least in the US. And as the other member of the panel mentioned, a lot of work has been done in Europe, in China, and in Korea. So from this starting point, let's say banks have to adapt. I think that first, the global regulation led us to change the way, let's say, we are connecting investors and corporates, because I think this is our major role. Mm-hmm. Maybe in 2006, 2007, we forget about this role to connect and to grow the financing from the investors to invest in the projects of the corporates or the sovereigns that are willing to support the growth. And so we need to connect that more. We need to get less balance sheets. This means also that we need to develop capital markets to fund these projects through bonds, through project bonds. And I think that there is a huge need in the next 20 years for infrastructure, developing energy, and I think that the role of the banking sector is definitely to go in that direction, and Societe Generale is one of the leaders of these two sectors. So we have to adapt in that direction. What also I think we should not forget is that, and Mr. Gramegna did not mention, there is also the Capital Market Union that the new Commission is willing to push forward, which in my view will be a way also to make the life or the fluidity, let's say, of the capital in Eurozone and in Europe much better. And I think that also it will help to support the recovery of the growth in Eurozone. So altogether, let's say, I think that we need to continue to make hard work, let's say, in terms of adapting our model. You mentioned that Paul Tucker said yesterday that it will take 20 years. I'm not sure that it will take 20 years. It will take shorter time, just because we have shareholders, and I'm not sure they will be passionate to wait for 20 years for banks to adapt their model. So we'll have to make choices. We'll have to refocus. We'll have to be more client-focused, client-oriented, sometimes to divest certain of our activities, sometimes to strengthen when we feel that it does make sense. I'm a firm believer of the fact that the universal banking model, which is the common model in Europe, in continental Europe, let's say, is a strong model as a way, let's say, to bring to clients all type of product they need, as long as you have chosen, let's say, the right angle, let's say, in terms of orientation of your platform. So I think also that what we will have to challenge is not just compliance, bonus, regulation, but also technology. Because I think that the banking industry so far, especially in my part on capital market investment banking, has not maybe been that much challenged by new entrants, contrary to the retail banking business. But, you know, I'm sure that with the new technology, everywhere you have some margin available for new entrants that could de-intermediate or deconstruct your model and take market share, they will come into. And so that's where we need also to be extremely attentive and agile going forward.
Okay. We'll come back now to Europe. And again, with the interest of time, we'll try and keep this round brief so we can get in something from the audience. Back to Europe. You're bullish, I understand why, but let's go back to what was said about China. China sent abroad to go to Japan to spend some money, the equivalent of the population of Luxembourg, which is just astonishing if you think about it. You guys are niche players, and with niche strategies comes risk, because if you get it right, you get it really right. But if you get it wrong, there's a lot of vulnerability built into that. So how does a country like Luxembourg, in a very uncertain future, protect itself? In a sense, what's your hedge? Can you have one on the scale that you operate?
Yes, that's a very good question. How do you hedge the risk? Number one, by making sure that what you do is compliant with existing rules, making also sure that we're working all together in the international community towards a common level playing field, because a small country like Luxembourg with a very large international financial center has to build on open markets, but common rules, be it inside the EU and also outside the EU. That's why the government has been very clear about it. We are going to adjust in terms of transparency in taxation. We've been doing that. We've abolished the bank secrecy. And I've heard a lot over those 2 days that this is being appreciated by investors, because they want you to be in a framework that is conducive to business on one hand, but is also compliant with the new regulations. That's point one. Point two, we have to find niches. I think we've been successful recently in attracting Chinese banks to Luxembourg. The 6 largest Chinese banks are present in Luxembourg with subsidiaries and branches, and therefore our country plays an important role in the internationalization of the renminbi. So I think I have answered your question in a dual way. I mean, you have to listen and to watch what's going on abroad. On the other hand, you have to pick your sectors, pick your friends, pick the right opportunities, and at the same time be innovative in terms of legislation in the global framework.
Fantastic. Turning again to China, you mentioned the One Belt, One Road strategy, and I think that's very much new to many of us. Could you say a bit more about that?
Yeah, actually, this is the Chinese new strategy moving towards a consumption-driven economy. China also seeking very hard to integrate itself with the rest of the world. How? What they do is they introduce this One Belt, One Road, one belt is a Silk Road economic belt, which is something like Silk Road on land, okay? And it originates from China, and then goes to the Middle East and ends at Netherlands. And
Luxembourg,
yeah,
of course.
Luxembourg,
Ends
yeah,
at Luxembourg.
Yeah, yeah. The other one road is the Silk Road on the sea, and start from east and south of China to the South China Sea, to Indian Sea Ocean, and to Gulf, Persian Gulf, and to Middle East. And all these things, all together in this area, there are 64 countries, of course, also including UAE, and the population living in these 64 countries is 4.5 billion people. So it's a massive investment. Is a long-term strategy, and but officially we don't have a figure. What kind of investment talking about, but for the infrastructure itself, we're talking about 22 billion US dollar. Wow. $22 billion US. So what they do is, suppose they will build the highway, road, and the ports and etc. So this is China really wish to integrate its economy with the rest of the world, more with the country in the region.
Okay, thank you. And again, if we move then from very small to very large, Korea becomes the medium-sized player in this. How do you take this as an opportunity to speak to Korea's strengths? Because you have China as a very powerful neighbor, but a very high consumption neighbor. And then you have smaller countries which can also offer things, which are comparative advantages to Korea's strengths. How do you move forward, given this new environment?
I think the new environment will be positive for Korean economy. As a matter of fact, last year we signed a free trade agreement with China, and we are the only country which has a free trade agreement with China, United States, European Union, and the Asian countries. So by integrating the markets for Korean firms, so they have the accessibility to the larger markets. So hopefully they can enjoy the economies of scale and have some competitive edge. So that's what we are hoping for.
All right. And finally, returning back to the banker at the end of all of this, again, this sounds very, very positive, but I want to ask you something that hasn't come up yet. The dollar, the United States, inevitably, the renminbi will become internationalized. We will have two reserve currencies. If the euro regains confidence and strength, we may have three. Does that make your job easier or more difficult?
First, I disagree. Let's say I think euro is still the second largest reserve currency. Renminbi maybe will at some point access to this status, but and thanks also to a lot of investment coming from central banks in Asia, in Middle East, we've seen the euro being well supported during the difficult times. So our job, let's say, will not be easier, let's say, just because we have three currencies, because let's say we are dealing with much more than that, and you've seen recently with Swiss National Bank decision to depeg, I would say that such type of decision on maybe a second type of currency is creating some lot of distortion. So I think that what we are willing, let's say, to propose, let's say, as a European Investment Bank, is to propose a lot of European investment opportunities, because I feel that and I totally agree with Mr. Gramegna, that currently there is a lot of stuff that has been done in Europe. We want, let's say, Societe Generale, we want to accompany, let's say, all investors from Asia, from Middle East, to tap the European markets, because I think that first, the current quantitative easing is leading to a cheap cost of funding. And second, there is a lot of opportunities because they could invest on equity markets, on credit markets at a time of an acceleration of the economies. And so we start to see, let's say, since the beginning of this year, a very constructive equity market in Europe. And I feel that investors all around the world should look at Eurozone as a land of opportunities for the next 18 months. As at some point we've seen also in Japan last year when the quantitative easing and also the Abenomics started to attract a lot of capital flows. We've seen capital flows coming back to Eurozone. It's not just, let's say, investing on peripheral countries, capitalizing on the QE and Draghi's messages, but also, let's say, on the fact that the real economy is regaining confidence. The real economy, let's say, and the governments have to continue, and then I take the blame maybe for my country, France, has to make structural reforms like other countries, so that, let's say, we could not just bet on the short-term benefit of the QE that will last only a certain time, but also that we can regain competitiveness and also regain the trust of investors. I'm sure that we are on the right track to go in that direction.
I think you heard it here. The global financial crisis is over. Everything's okay. We're calling it here. This is the panel that called it. And if you're all right, then that's great. That's wonderful. We actually have time for at least one question. Are there microphones around? If there are, please raise your hand. There, right, gentleman right at the front, second row. Is it possible to get a microphone down here? Here we are. Microphone's coming. Wonderful. You can raise your hand again, please, sir, so we can see you. Thank you. There we go.
Omar Mahana from NBAD. Many thanks for a very informative discussion. Quick question to Mr. Huang, please. China's total debt since 2007 has increased by approximately fourfold, just under 300% of GDP. Is that a point of concern? And if so, what measures are you undertaking to address it?
Actually, I mean, the Chinese government already see these kind of questions, issues, and they are the government level. They are now control the first thing they do. They send people to check really the debt is how much, and also this is one thing. If you're talking about the government debt, I think the Chinese government really have sources to solve this issue, because you imagine there's so many Chinese. Let's take one example that China have so many state-owned companies. They can easily, to sell some. They can get the money. This is one thing, and also China government control all the land. That's why this is another very, very strong source for them to repay them. And also, I agree that yesterday there is one discussion and one slide saying that China slow but still grow. As long as China still grow, they will be able to repay those debt. And also the China, I think there's always two things. One is some issues, some need to be solved, but on the other side, always there's many opportunity. Full of opportunity. Like I just mentioned, even for Chinese people go abroad is a huge amount. Even for people living in the countryside, move to the city, creates a great opportunity. So as long as the government look at this issue and trying to solve it, I'm confident that in China, the government very strong. They have many means, many ways to solve it. And the land itself, privatize itself, may already solve a lot of issues.
Okay, wonderful.
Thank you.
And we finished exactly on time, which is astonishing and rare. I would like to, yes? Oh, you got one? We're taking one more. We finished on time, so we can take one more. That's excellent. I love it when a plan comes together.
Absolutely. Hi, good morning. This is a question for His Excellency, the Finance Minister of Luxembourg. My name is Apostolos Bantis. I'm from Commerzbank. I work for a German bank, but I'm originally from Greece. I wanted to ask you a very quick question. I know it's a very difficult and challenging question, and perhaps the time is not allowing us to debate that. How likely do you think we are going to have a Grexit scenario, and is Europe really ready to withstand such a scenario?
Well, I'm happy that you asked the question because it's on everybody's mind. So I'm glad that you give me the opportunity to explain where we stand with our Greek partners. We have achieved in a short amount of time since the Greek elections to find a compromise, and that compromise is in fact a start of a procedure where we buy ourselves 4 months of time. And I think that's the least that we could do, and that's what we had to do because we were faced with a new government that had completely diverging views with what was done before. So I think we have already achieved one thing, is that we have a common basis to discuss together. Now let's see what the institutions, the three institutions, the IMF, the European Central Bank, and the European Commission are going to see in the review that they are starting now with the list of the Greek authorities. It's not going to be easy, but we're going to do it thoroughly. The Greek authorities have accepted that this is going to be done inside the existing framework, which is a lot of progress. They have committed to repay their debt as scheduled. They have committed not to roll back measures. On the other hand, they have gained some flexibility. They can change measures inside the framework if they compensate for those measures. So I think we've both put water in our wine or wine in our water. As I like a lot wine, I prefer less water, as you can imagine. But this being said, we must now work for 4 months. And I hope that diverging views, diverging comments will cease, because we need calm. We need calm to work. And to your second question, the Greek exit is not on the agenda. Neither Greece nor the 18 other Eurozone partners want a Greek exit. So we are working towards a solution where Greece remains inside. And in order to make sure that we can work calmly on this, we must refrain from making polemics and making statements that are not helpful. Well, I can tell you, at least for Luxembourg, and I would say for most Eurozone countries, that has been the case. And I hope that our new Greek partners will understand that it is to the benefit of no one if one pushes division inside the Eurozone.
There we go. And on that note, we are officially out of time. Thank you very much.
Thank you.